we need to be able to handle bank failures in a way that, does prohibit contagion. And that certainly has not happened in many instances that we could all point to.
That was Sandra Thompson, former director of the Federal Housing Finance Agency, the FHFA, and former director of Bank Supervision at FDIC. I'm Tom Weiss, one of 3 hosts on Banking Bad, where we look at past financial crises, the lessons learned, and what we should be doing to prepare ourselves for the next crisis. In our last episode of Banking Bad, we talked about the harm caused by bank runs, particularly when they start spreading to other similarly situated institutions. In today's episode, we look at the purpose of a lender of last resort, how that concept has evolved in the recent past, and whether, if managed effectively, it can help mitigate the damage caused by bank runs. Our co-host John Bavenzi, former Deputy to the Chairman and Chief Operating Officer at the FDIC, has first-hand experience in dealing with lender of last resort situations, and today discusses those issues with Sandra Thompson, who's had direct experience in how that, somewhat abstract concept plays out in a real-life crisis situation. I think a bit of perspective on the FHFA is useful before we start. The FHFA oversees one of the world's largest bond markets, combining the conservatorships of both Fannie Mae and Freddie Mac and the federal home loan banking system. The FHFA regulates something in the range of $8 trillion in mortgage finance. That is a truly mind-boggling number. John, fascinating topic. Great guest today. What do we need to know?
Well, thank you, Tom. What we need to know about the lender of last resort, it's supposedly the central pillar of our financial stability. Its role is to provide emergency liquidity to solvent financial institutions during periods of financial panic and preventing temporary liquidity problems from turning into systemic bank failures. An effective lender of last resort should be able to accomplish 3 main objectives. 1, mitigate the risk of bank runs. 2, mitigate the risk of contagion. And 3, mitigate the need for banks to sell assets at fire sale prices. The official lender of last resort in the U.S. is the Federal Reserve. However, the Federal Home Loan Bank System also plays a role as a de facto lender of last resort in crisis situations. Having overlapping lenders of last resort may seem like a good thing, but the issue we will examine today is whether this overlap approach to crisis management is desirable or whether we need to consider changes to that system to make it more effective. Our most recent experience with bank runs with Silicon Valley Bank in March of 2023. First, there was a bank run. Second, there were contagion effects. And third, banks were forced to sell assets at fire sale prices. None of the main objectives of a lender of last resort were achieved in this instance. And as Eric Spittler explained in episode 3 of Banking Bad, today's technological advances and increased use of social media make bank runs likely to become more prevalent and certainly more dangerous, raising the stakes in the need for an effective lender of last resort. To discuss this important topic today, we're fortunate to have with us Sandra Thompson. Sandra is a close friend, former colleague, starting out her career at Goldman Sachs, moving on to the Resolution Trust Corporation, where she helped resolve hundreds of failed savings and loans and was instrumental in developing their securitization program. Sandra moved over to the FDIC, where she rose up the ranks to become Director of Bank Supervision, and then later moved over to the Federal Housing Finance Agency, where she became Director over there. Sandra, so good to see you and welcome to Banking Bad.
Great. Thanks, John. Thank you for having me. I appreciate the opportunity. And actually, I forgot about most of the things you've mentioned, especially RTC and all those failed banks, but thank you.
Yeah, well, some things it's good to forget about for a while. Unfortunately for you, on this show, we bring up all those situations for you to remember. So just to set the background, for those unfamiliar with the Federal Home Loan Bank System, can you just give us a brief overview of how it works and how it's evolved to become sort of a lender of last resort?
Sure. And that's a great question because many people really don't understand the home loan bank system. And if I start at the beginning, Congress actually created the home loan bank system in 1932 during the Great Depression. And they were essentially a source of funding for institutions who were originating long-term mortgages, which primarily were thrifts. And at the time, their purpose was pretty straightforward. It was to provide liquidity to financial institutions so that they could continue lending, because during the Great Depression, the mortgage market was devastated, and housing in particular. And so the members of the system at that time were mostly thrifts and savings and loan associations. And the Congress did allow for insurance companies to become members of the home loan bank systems. But most of the original members were thrifts. So the original members were thrifts, and the purpose really was to provide liquidity to institutions so they could continue lending for the specific purpose of mortgage loans and residential mortgage loans in particular. You know, their primary business of the home loan banks is to make fully secured, low-cost loans known as advances to their members. And in the early years, when the system first started, the only collateral that was eligible to secure advances were residential mortgage loans. Now, these advances are really the heart of the home loan bank system. They're fully collateralized and they're flexible in terms of their maturity and structure. And on the funding side, the home loan banks really raise money by issuing highly rated debt in the capital markets. And this allows them to provide funding to their members at really attractive rates. You know, over time, the system has evolved beyond its original housing-only focus. While housing finance remains central to its mission, Congress, over the years, has expanded the membership and the eligible collateral, and the home loan banks have really become more of a broader liquidity provider to the entire financial system. So today, the system has 11 regional banks, and as you said earlier, it operates as a cooperative. Now, they've got different types of members. So at the onset, there were primarily thrifts, and now they have expanded the membership to include depository institutions, which is banks, credit unions, insurance companies, and later, the Congress expanded the membership to include CDFIs, or community development financial institutions. You know, they're also able now to accept different forms of collateral. When they started, it was residential mortgage loans only. And over time, they're allowed to accept, government and agency securities, Fannie and Freddie securities, commercial real estate, CMBS, or commercial mortgage-backed securities. They've got a wide range of activities that they now support beyond traditional housing finance. The interesting thing, and as it relates to lender of last resort, is the role of the home loan banks is really important during periods of financial stress. And we saw this during the financial crisis in 2008, during COVID, and as you've just mentioned more recently with some of the regional bank pressures. You know, when other funding sources pull back from the banks, the home loan banks tend to remain open and operational, and they provide what I usually call a reliable, on-demand liquidity. In that sense, they kind of serve as a bridge between private funding markets and the Federal Reserve, and they help institutions stabilize and serve their customers and communities. And this is done on an ongoing basis. But what makes this system unique is that it really sits in kind of a middle space. It's not a retail lender, it's not a regulator, and it's not a central bank. It's a wholesale liquidity provider with a cooperative structure, which means that it's really closely tied to the needs of its members. But it also benefits from scale and efficiency that come with their government-sponsored status. So it's interesting because when they started in 1932 versus where they are today in 2026, the collateral eligibility has changed, the membership has changed, and they really are providing support to a wide swath of activities more than home mortgage lending. And so it's was never designed to be kind of the lender of last resort. They were designed to provide liquidity, which they do effectively on a day-to-day basis.
Good overview. I mean, the federal home loan banks are pretty important in providing liquidity, but they've sort of gotten away from their original mission of supporting housing, and even the entire banking industry doesn't seem to be as much involved in housing as it used to be. We'll come back to that, but let's talk about lender of last resort. Given what happened in 2023, where neither the Federal Reserve nor the Federal Home Loan Bank system were able to prevent contagion, would you say that our lender of last resort system is broken?
Well, I think I would say this. The regional bank crisis and other failures over time really exposed the fact that the home loan bank system is not fit for today's environment. And I could give you just a couple of observations. And I say that because when it works, during non-crisis time, the system really works. The home loan banks provide liquidity, and the Federal Reserve Bank, when they're using the discount window appropriately, or when the banks are using the discount window appropriately, the system works when things are going well, and it works sometimes. But I do think that there are some changes that need to be made, and I'll just give you a couple of examples. One, like as you've said earlier, the Federal Reserve's discount window really is the lender of last resort. It was designed to serve that purpose. It's part of the central bank. And what I've seen is that some banks believe that there's a stigma associated with borrowing from the discount window. The second observation I make is because the home loan banks are used by members both in normal times and in times of stress, sometimes there can be operational issues with moving collateral from the home loan banks to the Fed, or just moving collateral to the Federal Reserve's discount window in a timely manner. And it's easier to pledge collateral because they do it all the time with the home loan bank. So the members, both the discount window and the home loan bank system, are both collateral based. And because members pledge collateral all the time, even during normal times, they are able to easily pledge collateral to the home loan banks because it's something they do all the time. And in times of stress, much of that collateral either should go straight to the Fed from the home loan bank or from the member. And they just many times don't have the experience. The third thing that I'd mention is that the home loan banks, because of some of the issues that I've just discussed, they end up being the de facto lender of last resort, which is not a role they were ever meant to fill. This is the role that makes the Fed's discount window lender of last resort role even more difficult. So it's really murky because in times of stress, the members of the home loan bank system are used to pledging their collateral to the home loan banks. And when it's time to move that collateral to the Fed, sometimes they just haven't or aren't able to do it in enough time, or they may not have the operational capacity to do so.
Interesting. Well, let's go through some of that a little bit more, particularly the stigma point. How did this happen that there became such a stigma associated with borrowing from the Fed's discount window?
Well, during the 80s and 90s, and I'll just speak to the 90s because I know that one for sure, a lot of troubled institutions borrowed from the discount window for long periods of time when the FDIC was trying to find merger partners for failing institutions. And the healthy banks really didn't want to appear that they were in trouble, so they became very reluctant to borrow from the discount window. Even during the great financial recession in 2008 and 2009, some banks borrowed funds from the market at rates that were way above the discount rate, which was clearly a financial disadvantage. And they did that because they didn't want to be acknowledged as being a troubled institution. The discount window borrowing isn't really disclosed in real time. Like when you borrow from the discount window, people don't say, there's not a list that says here are all the banks that borrow from the window. but it is made public with a delay. But there's still some sort of stigma, which is really why the banks often turn to the home loan banks first. And there are just so many issues associated with being perceived to be a problem bank. The thought really is if you're using the discount window, that there's some sort of problem that needs to be resolved, or the FDIC is involved. So there are just lots of things that are associated. That's been my experience.
Doesn't sound easily solved either at this point. What about operational problems? Are there others that come about in this process beyond what you've mentioned?
Oh, absolutely. Just the pledging process itself. When you pledge collateral, there's legal documents that need to be completed. And because, again, some banks, or not all banks, have used the discount window, some banks don't have agreements in place with the discount window in case something happens. Not all of the banks have pre-positioned collateral. So they don't have experience in pledging collateral to the Fed's discount window. They don't have the agreements in place. They haven't tested the system to see if it worked. And, you have to make sure that collateral can be moved from the bank to the discount window, or from the member to the discount window. And it has to be done in a relatively quick period of time, especially if you've got a stress situation. And to your point earlier, in 2023, we found that banks had collateral pledged to home loan banks, the different ones around the country. And when it was time to move the collateral to the Fed, they weren't prepared. They didn't have agreements in place, and they had never tested the system. And one of the things that happened was we, as regulator, got on the phone. We had our regulated entities, the home loan banks, call the presidents of the Federal Reserve banks to make sure that, these institutions were able to get their agreements in place and able to move collateral quickly. And so really, the system needs to be tested just system-wide in a broad manner, and not just on kind of an as-needed basis. One of the outcomes of the 2023 crisis, I was very surprised because I didn't know that, a lot of institutions did not have the ability to pre-position collateral. They hadn't tested the systems. I thought that all banks and thrifts had exposure to and operational engagement with the Federal Reserve discount window, and that just absolutely was not the case.
It really, these operational issues sound like something that could and should be cleared up pretty quickly, given the significance of trying to stop bank runs. Is anything being done about that?
Well, yeah, great question. And I'm pleased to say that this month, on March 13th, actually 2 years after the regional bank stress situations, President Trump has signed an executive order to look at housing, and contained in some of the order are things that are related to the home loan banks. I think this new executive order asks the FHFA and the Fed to look at modernizing the collateral valuation and transfer process between the Fed and the home loan banks. It also authorizes the home loan banks intermediate access to the discount window for home loan bank member depository institutions using, standardized collateral operation and risk management protocol. So for me, the notion that, there's reference to the home loan banks and the Fed's operational issues in an executive order is pretty interesting. And I do believe that the executive order asks for a report back in, I'm not sure if it's 120 days or 90 days. And so it does show that the country recognizes that there is an issue, with this lender of last resort, that roles and responsibilities need to be cleared up and that people are going to be working on it. I'd also mention, as you may know, that in 2024, FHFA started a review of the home loan bank system. We were looking at what would the home loan banks look like in a few years. They were going to be 100. And the name of our study was The Home Loan Bank at 100. Kind of what is the future going to be? And we did a study of all aspects of the home loan bank. We looked at lender of last resort, and we were very clear that the home loan banks are not supposed to be the lender of last resort, that there needed to be more communication, especially in a stress situation between regulators and home loan bank members. For example, you have a bank, it's in trouble. They need to talk to their primary federal regulator. The FDIC needs to be involved. The FHFA needs to be involved. And the Fed's discount window needs to be involved so that if collateral needs to move, it can move quickly, because what we don't want to do is, cause a loss to the insurance fund. And that's my perspective after having worked for the FDIC. If I'm sitting in my seat as a Federal Home Loan Bank regulator, what I hear all the time is that the home loan banks have not lost any money. And that's because all the collateral that's pledged to them is 100% pledged collateral. And so they get their money back. But I've tried to say that the home loan banks are part of a larger ecosystem. So even if the home loan banks are covered and they don't lose any money, someone in that ecosystem, whether it's the Deposit Insurance Fund or the NCUA Insurance Fund, is going to pay for the losses associated with failing banks. And it's really interesting because I can see both sides. But when you think about the financial ecosystem, you are a big part of it. And just because something doesn't affect, one particular entity, it doesn't mean that it doesn't impact the system.
Well, I can give you a great example there, as you're well familiar with. When IndyMac failed in July of 2008, the FDIC took it over. They sent me out there to run the bridge bank for FDIC. And one of the first things I noticed was about a third of IndyMac's borrowings were from the Federal Home Loan Bank of San Francisco. And the rates were pretty exorbitant. IndyMac was one of those banks that wanted rapid growth and so was paying higher rates than anybody in the country. But they were still borrowing from the Federal Home Loan Bank system at even higher rates. So I said that, we wanted to pay off those advances because we could substitute much cheaper funding, but I couldn't pay them off. They had remaining maturities of 2 years, and the Federal Home Loan Bank system got a lot of very favorable legislation passed in the 1980s. I'm telling this for our audience since I know you know this story. And one of those things was that if the FDIC took over the bank and wanted to pay it off, it would have to pay a prepayment penalty, which would make sure that the Federal Home Loan Banks didn't lose any money when they went and reinvested at perhaps a lower rate afterwards. So I asked, what's the prepayment penalty? And they said $340 million. And so I refused to pay. And most of that was what money that they said they would lose if they just let us pay them back. But they also built in administrative fees for our bothering them. So it was a situation where, as you described, if you look at the bigger picture, the Federal Home Loan Bank wasn't going to lose any money, but it was coming at the FDIC's expense, because when the FDIC sold the institution, the acquiring bank had to take those high-cost funds, and they lowered the premium they'd pay for the bank as a result. So it was a very expensive failure for a lot of reasons, but that was one of them. So we've talked some in this show about outdated legislation that should be fixed. In our first episode, we talked about broker deposits a little, and this is probably another example. A lot of those advantages, it seems to me anyways, that'd be my comment for your study if you were still there to have the study. Some of those advantages should be taken away because they're actually, I think, harmful to the system. If the federal home loan banks can't lose anything, they have no incentive not to lend to a failing institution. And we know that failing institutions ought to be resolved quickly so that their cost doesn't go up. So by delaying that, by funding them, it just adds to the failure resolution costs, which a lot of which is borne by the FDIC. So it was great that we're doing this study, and it's, hopefully the executive order helps in some ways, but in this show, we try to make recommendations to legislators too, and maybe they can look at some of those rules and laws to see if they're outdated.
No, I totally agree. I know in the study that we did, one of the items that we recommended was to take a look at the prepayment penalties, specifically for the reason that you mentioned. But at the end of the day, from my perspective, the home loan banks have to realize they're part of a larger ecosystem. So either the FDIC takes the loss, or the Deposit Insurance Fund or the NCUA fund takes the loss. But the loss is ultimately borne by the members, because if the DIF takes a loss, then deposit insurance goes up, the premiums go up. And the same thing is true with, credit unions and the NCUA. And all of the people that are going to have to pay these additional premiums are members of the home loan bank system. So you may not see it on the front end, but it impacts the system in so many ways. And the system should work like it was designed to work. It was never designed for the home loan banks to be the lender of last resort. That's the Fed's role. It's in legislation. And it just hasn't worked that way, at critical periods of time, especially for large institutions, because we could be talking about some large losses. But ultimately, whether the FDIC pays for it, whether the acquiring institution pays for it, the members ultimately are going to have to make up those funds one way or the other. And we collectively, as regulators, have to work together to make sure that people understand that there is an interconnectivity that is there, notwithstanding your individual role in the financial ecosystem. And I just think that point gets lost over time. And there's also a public confidence issue. And we can't have all these bank failures. And I purposefully forgot the bank failures that we had to deal with at the Resolution Trust Corporation, over 700 thrifts for whatever reason, and all the public confidence that was lost during the Great Financial Recession. We need to be able to handle bank failures in a way that, does prohibit contagion. And that certainly has not happened in many instances that we could all point to. And so I just think that, what is a system broken? It probably has lots of gaps that need to be addressed.
Well, you make some pretty powerful points. And clearly, the lender of last resort needs some work. It's too important not to. So hopefully, all of these initiatives are getting a lot of attention right now so that we're better prepared next time there's a bank run.
Sandra and John, can I just ask a question just quickly in there? Because I know FDIC does simulations, as does deposit insurers around the world. And it seems to me that if there was a simulation that involved the home loan banking system, that those sorts of issues that you just described, Sandra, would come out. Has that been contemplated, having a system-wide scenario planning or resolution type of scenario analysis?
When I was there, that was not something that we discussed or talked about, but I think that's a great idea.
You were part of a three-way discussion, I think, at the time, weren't you, between the Federal Reserve, FDIC, and FHFA to try to deal with some of these operational problems, because you were a key part of getting that to happen.
Well, yeah, it was part of the discussion. It was, part of what we were doing, almost every day, especially during the regional bank crisis in 2023. But I was referring to the actual simulation. I mean, I would say that my simulation was, the actual work that we did. One of the outcomes, as I mentioned earlier, from the 2023 crisis was that every home loan bank president called every Fed regional bank president to discuss, the issues and roles and responsibilities, some of the operational issues I discussed, lender of last resort. And they started the process of getting, documentation in order, pre-positioning collateral, and testing system movement. And I don't know, sometimes you start things and they kind of fall down the priority list, but it was important at the time and it remains important. I remember after we completed our study, we did a presentation for FSOC to talk about, the role of the home loan banks, how important it was, the role of the Federal Reserve, and the, members of the Financial Stability Oversight Council, or FSOC, are the Federal Reserve, the Treasury, all the financial regulators, the bank regulators. Heck, I talk all the time to bank regulators in their role as regulators of the members of the Federal Home Loan Bank system, and also the Fed as a regulator, but also as the owner of the discount window, because there are so many touch points and different roles and responsibilities. Lots of communication has to take place. And we've done this effectively for some institutions, primarily smaller institutions, because when an institution is failing, the primary federal regulator will likely, be in constant contact with the member institution. And I'm saying member because it's member of the Federal Home Loan Bank. The Home Loan Bank likely has collateral that's been pledged by that member because the member probably took out lots of advances, trying to prepare for, the fall off of deposits. And if that collateral has to be moved, we've all seen this process work and we've seen it work well, but it doesn't work well all the time. And when it doesn't work well, there are significant consequences. And again, we are really trying to improve the communication all the way around. Everybody needs to be at the table because we need to make decisions so that if there are operational issues where collateral can't move, we can let the FDIC know in their role as either receiver, or we can let the primary federal regulator know that these are things that we can work on. But I think if we work and communicate more effectively as regulators, I think that could be a big part of the solution as well. Everybody has their role to play, but when you have a failing or troubled institution, you need to come together and have the conversations that need to take place so that the actions and priorities can fall in line the way that they should, because sometimes failures can be prevented. And we've seen that happen previously.
Yeah, I know that from our experience, when there is a crisis, the communication between regulators is very good, but then it kind of deteriorates in better times when there's still plenty of work to do to get things prepared for the future. So hopefully, that's being recognized more and more by regulators, as cooperation should be all the time, not some of the time. Before we let you go, Sandra, let's jump back to housing a little bit. You did start this big review at FHFA, talking about the role of the federal home loan banks, and what recommendations would you have to try to help with home ownership in the country?
Well, I think that the home loan banks are excellent providers of liquidity. They do it all day, every day, and they've been just great for community banks and some of the larger institutions. I think the message that I would have is I'd like to have, equal value placed on, the mission of the home loan banks. I had mentioned over time that, like when the home loan bank started, only members that were eligible were the ones that were providing, loans for the purpose of residential mortgage lending. And the purpose was, to provide liquidity for those institutions. And somehow over time, the legislation was expanded to include depository institutions. I think FIREA included the insured depositories like the thrifts and the banks. And one of the criteria that was included in that legislation was, if you were going to have access or be a member of the home loan bank system, at least 10% of your assets had to be tied to mortgages or mortgage loans. And the interesting thing is that, members, when they apply, that likely was the case, but that was a requirement that took place at the point of membership, but not over time. So you could have a situation, let's say, like one of the large regional institutions in California that failed in 2023, where they may have started out as a member with meeting the 10% requirement, but over time, they got involved in other activities like cryptocurrency or others. And so the funding from the home loan banks is providing support for activities that are far removed from residential or any mortgage home lending. And so I'd probably want to ask the Congress to think about increasing the requirement that the home loan banks place on affordable housing. Like right now, they have a 10% requirement where they pay 10% of the prior year's earning. That has to be directed towards affordable housing. One of the recommendations that I did make to Congress was that they increased that 10% to 20%. I said at least double, the requirement for the focus on mortgage lending. And I say that pretty comfortably because, the home loan banks don't pay taxes. And when you look at, they don't pay state, they don't pay federal or other taxes, they're getting a huge tax break. And even Fannie and Freddie pay taxes, and they got bailed out by the government and are still in conservatorship. And so I would say either increase your lending to 20% from 10 to 20, or start paying some taxes, one or the other. You can't get the benefit of being a government-sponsored entity without the responsibility of doing what the legislation and statute says you're supposed to do in the first place. And I'm not saying that to say that the home loan banks don't do residential lending or commercial lending or things that are tied to mortgages, but there's a lot more that they could do, especially now since we're having this affordable housing issue across the country. And I mentioned the president's executive order, but housing really is bipartisan. It is an issue that I believe everyone in Congress is concerned about, whether we agree on every single point, or whether they agree on every single point is neither here nor there. But I think it's widely known and widely recognized that housing is fundamental to this nation's economy. I think it's 12 or 13% of the GDP. Like Fannie and Freddie and the home loan banks are $8 trillion out of a $14 trillion market. And so you've just got to pay attention. And so I would just say that the home loan banks can do more. They're doing a lot, but they could do more. And if they don't do more, then maybe we should think about some of the benefits that they get from being a government-sponsored entity. They get to issue debt at lower rates, that Fed funds. And so I just really think we need to weigh the costs and the benefits of some of the things that they're doing and maybe look at how we can level those out a little bit.
You make a great point, Sandra. It's not like, the banking industry owns the federal home loan banks. And so the federal government is subsidizing the banking industry with all of these tax breaks and implied government support. So it's not like if the banks put more toward housing that they're providing charity. They're getting a benefit that they should have some public purpose associated with if they want to keep those benefits. So I'm glad you made that point. It's very powerful, I think, and for folks to take a look at. I'm really pleased with this discussion. I don't know if you have others points you want to make or recommendations for anyone, Sandra, before we wrap up. But this has been a great discussion.
Yeah, I think I'd just like to double down on a point you made earlier. People recognize that roles and responsibilities need clarity, especially as it relates to the home loan banks, the Fed's discount window, and the lender of last resort. And there seems to be starts to address the issue. They start and then they become a lesser priority. And I would just encourage, everyone, all stakeholders who are involved to really make this a priority because there's too much at stake. Bailouts are very costly And we've seen that story a number of times during our careers. And so just to take the time to finish the process and make the system more effective, especially during times of stress, by clearly defining roles and responsibilities, by operationalizing, the movement of collateral, by doing all the things that we know need to be done. I'd say let's take the time now, get it done, so that we're better prepared for the next crisis, because we know there's going to be one.
Well, I don't think there's anything to add to that comment. You've stated it very well. And so on that note, I think we'll conclude for today. And Sandra, we want to just thank you for being here. Really glad to be able to have you on the show. So thank you very much.
Great. Thank you for the opportunity.
Thanks, John and Sandra. As John mentioned, lender of last resort is a central tenet of the U.S. or any financial system. When a crisis situation occurs, that role is key to protect against crisis risk and ensure the proper functioning of the financial system. But Sandra also made it very clear that preparing for financial turbulence should not wait for an actual crisis to emerge. When someone with Sandra's experience suggests that the lender of last resort financial machinery in place needs clarity of roles and responsibilities and needs to have operational confidence it would actually work in a crisis, then it seems the system would be well served to listen to that advice. Thanks, Sandra and John. Please join us on our next episode of Banking Bad, where we revisit past financial crises and uncover lessons that we can use to prepare for the next one.